Welcome back to the Economic Analyst channel. In this video, I'm going to cover the recent moves that have been made by the Federal Reserve to finally tighten monetary policy, raise the federal funds rate, sell off some of its assets off of its balance sheet, and how that's going to impact our economy. Now, in my opinion, these moves are too little too late, because the negative interest rates, that is when you take the federal funds rate and subtract out the year-over-year consumer price inflation rate, are at all-time lows. They're lower now than at any time that we had negative interest rates during the 1970s, and that was the last time that we had really high systemic price inflation. And the Federal Reserve has announced that they're going to hike the federal funds rate by a whole quarter of a percentage point before the end of this month. But negative real rates right now are at negative 7.8%, and the CPI is projected, my projection of the CPI that is to increase to 8.1% from 7.9. So that's going to be a 0.2% increase, countered by a 0.25% increase in the federal funds rate. So negative real rates, real interest rates are going to stay negative pretty much where they are right now. The tightening is not going to be really, having any kind of effect for a while. And so because of that, we're still going to have systemic price inflation. In other words, the Federal Reserve has made its moves too little too late. It's not enough to really stave off the inflation crisis that we're facing, and it's too late to do so. The inflation is systemic, it's ingrained, and it's going to stay with us quite a while. Now, the Fed has indicated that they're going to hike rates 6 more times before the end of this year, which means that the federal funds rate will rise to 1.75% before the end of this year. And quite frankly, I was very surprised that they were going to hike interest rates that much by the end of this year. I was really expecting them to do a quarter point per quarter. But the fact that they have already indicated that they're going to do a half a point per quarter, then that means that the federal funds rate will end up between 1.75 and 2% by the end of this year, which will translate into a bank prime loan rate of 5% by the end of this year. Now, I've created a debt default model which takes into account loan data against GDP and the bank prime loan interest rate, and basically figured out that when it reaches a certain threshold on this default model, that it triggers recession. So you can see how it's been pretty predictive of the last 3 recessions, and even predicted that we would have some type of problems in the financial sector in the late 2010s. And we certainly did in quarter 3 of 2019, when the Federal Reserve had to basically reverse its tighter monetary policy due to a liquidity shortage. So the name of the game is which one's going to hit first. Are we going to get hit with a crash that has been caused by rising default rates and delinquencies on loans like we saw in 2008, or we saw in the early 2000s or 1990s? Or is there going to be a liquidity shortage like we saw in 2018 and 2019 that almost caused the Fed to lose control over its interest rates and had to form tighter monetary policy? Well, based upon the delay that I see between the default rates model, a rise in this default rates model, and the actual rise in delinquencies and defaults on loans facilitating a recession, my guess is that we're going to see the liquidity shortage in the reserves market first. So when bank reserves get depleted, and they get depleted down to a point where quarterly government taxes start draining reserves to under, say, $1 trillion, could be even less than that, could be under $500 billion is the threshold, that will result in a liquidity shortage. And we'll notice that when we start seeing the overnight interest rates start pressing up, and the federal funds rate starts increasing beyond the parameters that the Fed has set. Because the Fed sets a quarter percentage point parameter, and during 2019, the federal funds rate started to move up from that parameter that the Fed set, despite the Fed trying to pump money into the federal funds market. Why? Because the reserves got drained so much out of the banks, and so the interest rate on excess reserves was not enough to really keep that channel. Overnight interest rates started to rise, and so that started lifting the federal funds rate. We may actually see that again sometime around January of 2024. And the reason why I say that is because even though, according to my default rates model, that the rate that the Fed is planning to hike rates by the end of quarter two this year in 2022, my default rates model is going to go red, meaning that we should start seeing a beginning increase in defaults and delinquencies on loans shortly thereafter, perhaps within 6 to 9 months after that. Again, there probably won't be enough time to manifest to where it will result in the bursting of a credit bubble. And even worse case scenario, while a recession would be extremely terrible, especially caused by defaulting debts, since we have record amounts of debts in our economy right now, if we reach a point where there's a liquidity shortage, the Federal Reserve may feel obligated to reverse its so-called tight monetary policies, which is really just less loose. And then that means we may have negative rates for longer because the banking system can't maintain its sustainability at the relatively higher interest rates thanks to such excess debt. And that means we're going to have systemic inflation for longer. So really here, what the Fed has done is that it's tried to navigate between Scylla and Charybdis, so to say, to draw from the Odyssey, and instead we're going to get hit with both. And that's what happened in the Odyssey with Odysseus' fleet. They navigated through the caves, got attacked by Scylla, ended up being shipwrecked by Charybdis, and everybody died except for Odysseus himself. And he was marooned on an island for 7 years with the witch Calypso. I think that we're probably going to see that again. So this systemic inflation will be bullish for precious metals and commodities, so-called, going forward right now. Now, we are seeing a retracement in precious metals since they started peaking in early March because of the onset of the war between Russia and Ukraine. And I sort of warned you about this. I gave you a warning around the beginning of March, that we might see this pressing up in precious metals and commodities, but that may not be sustainable because it was really driven by geopolitical circumstances. It was really unknown just how long this would last, though I am a little surprised that it's lasted so shortly. I was expecting it to be systemically longer. In either case, the upward pressure on precious metals remains the same. When we take a look at the 2-month trend since practically the beginning of the year, you can see the strong uptrend in both silver and gold. That will probably maintain itself. And the reason why I'm so confident in that is because rates are so negative. Negative rates are usually bullish for precious metals. We saw this in the late 2000s and the early 2010s when gold was pressing up to $1,800 an ounce and silver was pressing up to $50 an ounce. We saw this during the 70s, especially in the late 70s, when gold would peak at over $850 an ounce and silver would reach $50 an ounce for the first time in 1980s, after gold had risen from $35 an ounce and after silver had risen from a little as $2 an ounce. That was a 25 times return on your investment in precious metals if you had held all through the 1970s until the beginning of the 1980s. And it was only Paul Volcker's staunchly high interest rates here at the end of 1980 that really popped that gold and silver market. We're probably not going to see that this time, and instead this is laying the foundations that we're going to have a rise in precious metals. The Federal Reserve is so far behind the curve, and even though Jerome Powell has come out and admitted that the Fed is behind the curve, he has yet to let on and acknowledge just how far behind the curve the Fed is, and it's only a matter of time before market participants wake up and realize this matter. So we are definitely in a precarious situation. We are screwed 3 ways from Sunday. We're either going to have systemically high inflation, defaults and delinquencies on loans leading to a next credit crash, the likes that we have not seen since the Great Depression, or a liquidity shortage, which will force the Fed to reverse its monetary policy and engage, which will create higher inflation. My guess is that this is the scenario that we're going to see. Before the Fed pops the credit bubble, before the credit bubble completely bursts, and we start seeing a full-blown recession, we're probably going to see moves up in the overnight interest rates and the federal funds rate. When we take a look at the federal funds rate, and I'll bring that up right quick just to show you what to look for, you have to look at what the Federal Reserve was trying to create with its channel, and then look at the daily rate on that federal funds. And when we see that, and when we take a look and go back to 2019 here, when the Federal Reserve was starting to drop its Fed funds rate, notice here that in this channel, they would create a channel. And so here in March and April and May, they held the channel between 2.25 and 2.5%. Now, normally, if it's higher than the midpoint between that, it's because there's been some upward pressure being placed on this interest rates, like what happened here in April 29, 2019. And that's because the overnight lending rates were being pushed up, because even then banks were beginning to be strained by a liquidity shortage. So the Fed drops interest rates. But look what happens here on September 9th through the 18th. We see that the Federal Reserve was drawing between 2% and 2.25%, and it raises all the way up to 2.25%. It reaches that ceiling threshold on the Fed funds rate channel. And so on September 18th, the Fed had no choice but to actually intervene in the repo hypothecation markets, that is the collateral, short-term collateral lending markets for the banks, and start purchasing that collateral in order to calm down these interest rates. We may very well see this again. Right now, the Federal Reserve, the federal funds market is showing that it's being flushed with cash, and that's not too surprising here, because we're seeing record Fed repos, the Fed actually selling repo bonds, repo loans, so to say, to the banks to the tune of 1.6 trillion a day. They're repurchasing them the very next day. But the fact that they're actually, having to sell these short-term collateral loans to the banks tells you that the banks are flushed with too much liquidity right now, not too little. So we're probably not going to see any problems manifest in the banking liquidity sector of the markets until late 2023, early 2024. And my guess is that we won't see it until early 2024. And if I were really to put a hammer on it, we may not even see it till March 2024. And the reason why I say that is because that's toward the end of the first quarter, when quarterly tax payments are due. Never mind the fact that that following April comes the annual tax payments, and that will draw down on personal accounts as well. So keep on the lookout for that. Those are the three things to watch out for, and I will post updates to this regularly. So I will post it, definitely keep you updated on my default rates model if anything starts changing on this, and I'll post an update when we start seeing the model turn to red, and that will give us a clue to start looking out for the rise in defaults and delinquencies on loans, which are pretty predictive of economic recessions, especially when we see these delinquency rates increase by 20% year over year. Right now, defaults and delinquencies on loans are at all-time lows. That's not surprising. We've had record low interest rates, very generous monetary stimulus entering those markets to calm down that debt situation. Once that stimulus and once that those training wheels are taken off, we're going to see on which of the kiddies here can actually ride on their bikes, and we're probably going to see a lot of crashes take place, unless if we get a liquidity shortage first that forces the Fed to reverse its monetary policy. Either way, even if we get a crash that temporarily calms down the inflation rate and brings it back down to normal, that will just incentivize the Fed to bail out the banks, to bail out the failing businesses with more monetary stimulus, which then means we'll get more inflation, just like we did with the COVID situation. So either way, this is not good for the price stability. It's not good for the value of the dollar, and it is very much a bullish time for gold and silver. Now, one last thing to note here is that the Fed's pricing of rising interest rates probably means that we're going to see a spike in the 30-year government bond interest rates higher than what I anticipated, And based off of my model that analyzes the stock market and uses the 5-year GDP growth rate and the 30-year Treasury rate, which has been, pretty good at channeling and charting out, stock returns based upon how they're valued by this 30-year Treasury rate and the 5-year GDP growth rate, we are probably going to look at a market correction of about, say, 15% from where they are right now. It would actually mean probably close to 20% from where the market was at its peak at the end of 2021 and at the onset of 2022. So the Wilshire 5000 will more than likely correct down 10 to 15% from where it was right now to about 38,000, and that probably translates into a Dow Jones Industrial Average of about 30,000 points and an S&P 500 of about, say, 3,800. So that's something else that you need to look out for, is this correction in the stock market. That bearishness that manifests in the stock market will be bullish for precious metals once again, as investors tired of seeing dismal returns in the stock market will then start buying precious metals. But commodity ETFs will also get a boost from this because of inflation. We're already seeing a drive in commodity ETF fund performance, and I would expect, I'm going to see if I can't pull one up right quick and pull up the charts with this. My guess is that we will start seeing these commodity ETFs start to increase in value, and that will be one haven of the stock market that one can use in order to have an increase in their traditional portfolios here. And I can't really find one right now, but the last one that I checked, and pulled up a couple of videos ago, let's see here, let me pull up the DBC commodity index right quick. Yeah, here we go. We can see how, we're seeing this increase in commodity prices, and even though they corrected from their highs, they're still higher than what they were in February by a good 10% or so. So that's a good alternative to stocks, a good alternative to precious metals that can yield real returns. In the meantime, I expect to see more of a correction in Bitcoin, although Bitcoin right now is at systemic lows from where it was at its peak in November, but rising interest rates will probably keep Bitcoin from having any type of real returns. So sorry to the crypto holders, but we're probably never going to see Bitcoin push up, say, over $50,000 a coin ever again. We might see some upswings here and there, but eventually higher interest rates are going to force the crypto markets downward, at least initially. Now, that being said, if we see a situation where reserves are very much shortaged inside of the banking market, and the Fed has to reverse policy and start printing money, that can definitely be bullish for Bitcoin. The reason why I say that is because back in 2019, when the Fed had to reverse its policies here and start, actually dropping its interest rates and intervening in the Fed markets, shortly after that, about 6 months or so after that, we started to see a bottoming out in Bitcoin and cryptos, and they started their ascent. We did see a drop in Bitcoin from the stock market crash due to COVID, but absent of that, we started to see a push up in cryptos from that point forward until they reached their megalithic prices that they have had reached right now. And although they still seem to be holding at these very high rates, at these high prices, high interest rates caused by the rising of the 30-year Treasury bonds are probably going to depress those crypto prices, and we'll probably see them come right back down to earth in the near future. Now, how low can they go? I'm not really sure. Will we ever see Bitcoin fall below $10,000 an ounce? I really have no clue, because it's very difficult to analyze this. But when we take a look at the Treasury, the 30-year Treasury rate now, which is at 2.5%, that's way lower than what it was in 2019. And indeed, until we see rates start increasing back up to, say, above 3 to 3.5%, that will tell the tale on whether we see Bitcoin hold its price where it is, or if we start seeing it start breaking down and falling below this $30,000 floor, so what to say, and start coming back down to earth. If I were to guess where we're going to see the next correction in crypto market prices for Bitcoin, my guess, $20,000 a coin. We'll probably see it chop in half, and it will trade around this $20,000 to $30,000 a coin era for a while before the Fed lowers interest rates, and then that could be bullish for cryptos in the near future. So I'm not the ultimate crypto bear here, but I do treat it as a speculative investment at this point in time because, quite frankly, there's no limit to the amount of digital tokens that can be made to compete with Bitcoin. Bitcoin is not a precious metal in the sense of gold and silver. Nobody is ever going to find more gold than there is existent. Nobody's going to ever find another precious metal. They've already existed, and the supply increases very slowly. But cryptos can be generated every single day of the week, and they will continue to do so as long as there's an attraction to the crypto market that's driven by speculation and greed. That's my take on that, guys. So, just to recap, we're all thoroughly screwed. And when do I think that we're thoroughly screwed and the screwiness is going to hit us? Probably sometime in early 2024. It means we've still got about a year and a half to prepare, but until then, we're probably going to see a push up in the precious metals prices and a resumption of the precious metals bull market that began in 2020. It kind of stagnated in 2021, but we're going to see this press up in 2022 because essentially the Federal Reserve's tighter monetary policy is going to kill all competitors to precious metals. It's going to kill the crypto markets, it's going to kill the stock markets, and it's going to kill the bond markets. All those prices are going to go down, commodities are going to go up thanks to inflation, and negative interest rates will also push up precious metals. Guys, if you like my video, if you like the content that I provide, make sure you just click that like button, show me some support. Subscribe to my channel if you haven't already, and drop me a comment. Let me know what you think about all this. I'm curious to hear what you say and think. Have I missed something? Am I right on the dot? I love to know your thoughts on this. As always, just stay tuned to my updates on the videos that I do make. I'll make them out periodically as time goes on. I'll try to push one out once every couple weeks or so. But yeah, we're definitely entering in some very volatile times between the geopolitical and economic situations that are going on in the macro status. So keep on the lookout for that. I will be on the lookout for any kind of changes in the trends that I've noticed. And as soon as I do notice these things, I'll give you the updates on this channel. Once again, guys, I thank you for watching this video, and I'll talk to you next time.